0.7% GDP growth. That's the number. Sounds small, right? Like the discount you get at a gas station if you sign up for the exclusive rewards club. How does it affect investors and the New Zealand housing market? Westpac's chief economist, the popular Kelly Eckhold, returns with the answers. Keep watching to the end if you want financial freedom faster.
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everyone else do it, hit that subscribe button and get ahead because this is New Zealand's fastest growing real estate and investment show. Westpac's chief economist, Kelly Eckhold, is one of the sharpest minds in the game. Kelly, you guys believe this 0.7% figure is overstated? What's the real growth rate investors should be factoring in?
Yeah, there's a bit of statistical noise in the GDP data right now. So we would really say that 0.7 is really more like about a 0.3. If you smooth from that, what we think has happened is that some of the weakness that was reported in the June quarter data has really just been borrowed, basically, and it was paid back in the December quarter data.
Let's go into a little bit more detail there. What was surprising about the figures, and should we be excited yet or not?
Well, I think we should be encouraged because even though the 0.7 number probably overstates the actual amount of growth here, the fact that we got growth at all, even abstracting from some of those statistical factors, is actually a bit better than we expected because we kind of thought that we were either going to have a flat economy in Q4 or perhaps even another small negative outcome. The areas that I think have surprised have been factors that perhaps have just been a little bit underappreciated from the perspective of people who live in the major urban areas. So one thing we noticed, for example, is that tourism spending has been increasing quite sharply, and that's been reflected in a few subcomponents of the CPI, thinking about retail trade and consumption, etc. We also noticed that local government spending has actually been surprisingly strong. Now, when we've usually forecasted local government spending, we've tended to bunch it in with central government spending and had a view that there wouldn't really be significant extra spending coming from there because the central government has been trying to run a pretty tight fiscal ship. But what this data showed us is that it's certainly the case that the central government isn't spending any more, but the local government is. And I guess the way that you can think about it is that all of that rates money that we've been paying is going somewhere, and it's going into investment, in particular in infrastructure, and that's coming through the figures. That's pretty encouraging, I think.
Well, it is. I guess New Zealanders do pay their rates, generally speaking, so it's a good sign. I'm sure a lot of countries have problems with that. I saw you posting on LinkedIn, and you're a good follow, by the way, that there is a lot of strength in the mortgage market at the moment.
That's right. There's been a real upsurge in applications for mortgages. Part of that is seasonal because this is the busy time of the year in the housing market, but actually there's a couple of other factors at play. Firstly, there's quite a lot of mortgages coming up for refinancing right now, so there's a lot of Kiwis that have their old fixed rate rolling off, and they're responding by looking to pick a new rate, and they're kind of doing that. So that's increasing applications. To some extent, Kiwis, I think, are shopping around a little bit as well, which has meant that there's been an increase in applications. But the other thing as well is that house sales are definitely picking up. We saw house prices picking up in the last couple of months, now in positive territory quite firmly. So that is all being reflected in an increased amount of activity in that mortgage market right now. And realistically, that's going to continue for the next 6 months or so.
So how's the RBNZ likely to interpret this data, and what other policy tweaks could they potentially make that could significantly impact the property market?
So I think they're going to view this data probably with a bit of relief, actually, because the reason that they've been doing all of these interest rate cuts is to try to revive the economy. And the data that we've seen, those forward indicators we're talking about, they should really give them heart that it's having the impact that they want. I think, though, one of the things that they will be thinking about is exactly how many rate cuts they need to do now. They've promised us quite clearly that they expect to do at least 2 more rate cuts in the next few months. And I think there's probably still a reasonable basis that they'll follow through on those promises. But, in terms of thinking about perhaps one other cut in the back half of the year down to 3%, I don't know if that's looking so likely now, given that the inflation outlook is actually looking like, and headline inflation is going to go up a bit because that exchange rate's fallen. And also with the recovering economy, it's not totally clear to me that the economy is going to need a lot more stimulus right now.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart, subscribe. So if the OCR rates do kind of bottom out at that 3.25% range, is that going to keep getting passed on to Kiwis through lower interest rates, or are we almost there?
We're almost there. The financial markets are kind of well ahead of all of this. They've basically had that sort of 3.25%, perhaps some chance of 3% interest rate priced in for a while. Those wholesale interest rates are the ones that banks have been using to work out where they should pitch their mortgage rates. So if you look at where the 1 and the 2 year and the 3 year mortgage rate are now, that's fully consistent with that view that I'm talking about. There perhaps is going to be some scope for very short mortgage rates to keep falling a bit, maybe the 6-month rate, for example. But I actually suspect that with mortgage rates generally sitting now pretty close to that 5% mark, that's pretty much what we should expect, unless something bad happens and the Reserve Bank is forced to cut rates a bit further.
There's still plenty of commentary I've seen in inflation ticking back up for a while. Is that going to play against this GDP getting a bit better?
Well, I mean, it's one of those factors where the Reserve Bank will have to think about, well, just how transitory is that increase in inflation going to be. And there, the guidance they've given us quite reasonably is that they think that while the economy remains a little bit slack, and even though we've seen a bit of growth, it's still quite slack, then there's probably still good reasons to believe that any increase in inflation being driven by import prices won't last. And if it doesn't last, then it's not something that the Reserve Bank needs to be really worried about. For example, to start thinking about putting up interest rates right now.
Let's take a look at the house prices for a minute. 3-month rolling average house prices. I saw that there's a lot of positive movement there.
Yeah, well, that just reflects that steady momentum we've seen on the underlying monthly data. And I use that indicator to be able to sort of benchmark my quarterly forecast for house price inflation. Now, our current forecast is that for the first quarter of this year, we would get about 1% house price growth over the quarter. We got off to a pretty slow start to the quarter, but the most recent data are pretty encouraging. It actually looks achievable that we could see that. And then after that, I think I'm looking for quarterly rates of house price inflation closer to 2% for the balance of the year, which if you add that up over the year, it gets you to the 7% forecast I've got for the year.
And South Island house prices, bit of a surprise there.
Well, I don't know how much of a surprise it is, but it is quite interesting. There's quite a significant regional variation in housing market strength over the last couple of years. And I was pointing out that if you look at the lower half of the South Island, where there's a much stronger weighting in those local economies to tourism and to the agricultural sector, you can see that those housing markets have been a lot more resilient than if you look at, say, Wellington or Auckland prices. So Southland house prices, for example, are actually higher than the peak that they got to back in 2021. I think that just tells you that those positive drivers of growth that we've been talking about for a while, stronger tourism, stronger external sector, are all kind of having the impacts you would expect, because you would expect the initial impact to go through in the regions that are most leveraged to those things, and then gradually that income will start flowing into the cities.
And do we think this is a result of farming, like exports and dairy and meat and forestry impacting those regions, or something else?
Well, I think it's quite likely to be particularly affected by the dairy sector, where there have been quite strong income flows in the last year. Down in Otago, I think it's actually quite driven by the tourism flows, and it's apparently very busy down around Queenstown, Wanaka at the moment with tourists coming in. I was in Christchurch quite recently, and I was surprised at the number of American tourists that I saw around the city. But then when I consulted the figures, I realized, well, I shouldn't have been surprised because visitors from America are actually at above pre-COVID levels now.
Yeah, those holiday hotspots are showing some of our property investor clients getting very high incomes from those short-term stay properties, and it's great to see. Looking at this consumer confidence, the 5-year data, things are improving.
Yeah, there's an improving underlying trend there. There's potentially a bit of bumps in some of the data, like the ANZ monthly survey, for example, just had a little fall back in the last month. One thing to kind of keep in mind here is that when people turn on the TV in the evenings, they're hearing a lot of scary stories about Trump tariffs and trade wars and actual real wars as well. So it's probably reasonable to think that we will see a few bumps in the road with respect to business and consumer confidence as we go through the next 6 months or so.
There's a time to bet big on the regions then.
Yeah, well, I mean, in the end, money talks, right? And in the regions, I've got some money. So whilst they might see the scary stories on the telly, probably in the end, if their businesses are doing well, if they're getting a decent amount of income through the door, that will probably be more important in terms of what they ultimately do.
I really do appreciate your insights, Kelly, and recommend people check out the Westpac economic data and reports you guys are bringing out all the time. It is truly valuable. Thanks for joining us again, Kelly, and we'll get you back again soon. Just a reminder, every video here gives you an advantage in the property game. If you want to own property or just like the idea of financial freedom, subscribing is the easiest, smartest decision you'll make today. So do it before your competition gets further ahead.
Less debt, more cash, passive income coming fast. Make your money work for you. Live the dream, it's overdue. So don't just wait, take control. Mortgage HQ will make you bold. Financial freedom's in your hands. Take that step, it's